has become.
Welcome to tonight's live stream where we are going to discuss the 2024 stock market hits, the misses, and I think most importantly, where we are right now. We're also going to do a couple of raffles tonight where you'll have an opportunity to win a gift card to your favorite restaurant. So you should see a QR code on your screen for an opportunity to register for our weekly stock market update. That is going to also enter you into the opportunity to win a gift card to your favorite restaurant. So with me, as always, Chris Paris, our Chief Investment Officer, Charles Scavone, Director of Investments here at Oak Harvest Investment Services. Guys, welcome to tonight's live stream.
Glad to be here.
Great to be here.
So what I want to do is make this as interactive as possible. So we have some pre-submitted questions, and I'm going to do it a little bit differently this time because I'm going to make sure to get to some of these questions, and I'm going to do it early in tonight's broadcast. So Thomas, Brett, Terry, and Alan, and if we have an opportunity, Gary, we're going to get to your question as well. But what I want you to do is to put questions that you have that you would like the investment team, myself, to discuss on tonight's live stream. Feel free to put those in there because we really want to make this as interactive as possible tonight. So let's jump right into it. So where are we right now? December 2024. It's been, I read something online the other day that so many analysts and pundits really got this year wrong. Let's go back to the beginning of the year, kind of what was expected to happen, what actually transpired, what were some of the hits in the market, what were some of the misses, industry sectors. Start, Chris, with you.
Well, Charles has all the data.
So we'll start with Charles.
No, but as far as, I can say where we started the year, we were optimistic on the year. We did think there was going to be some heightened volatility throughout the year, which actually really didn't happen. There was only the one decent pullback during summer after July 4th into early August, and that wasn't due to anything here in the United States. That was due to some leveraged traders over in Japan, and that was a sell-off, I think, was it around 9%, something like that in 3 weeks. But we basically V-bottomed and rallied on through towards the election and up strongly after the election. And
until yesterday, basically.
Until the Fed decided they wanted to be a Grinch in front of Christmas, yeah.
And so we are going to get into what happened yesterday because the S&P was down about 3%. I believe the NASDAQ was down about 3.5%. We didn't get the bounce back today. We did maybe partially for a portion of the day, but it ended kind of flat, I believe. So we are going to get into what happened yesterday and what that means for the rest of the year. But Charles, some of the data for 2024, where should have investors been and where should they not have been?
Yeah, a couple of maybe broader overview points. First, to Chris's point, we're always, during the course of most of the year, the first part of the year, a little bit cautious, perhaps too cautious, particularly thinking in the first quarter of the year. Usually get a pullback. We may have held a little bit too much cash in some accounts, got a little bit drag there. But we were continuously watching this path of economic data that was showing slowing, and became concerned about the inactivity of the Fed. Was the Fed too late? And that became sort of an overlying concern in the markets. That was probably the biggest one, and that was probably resolved when the Fed did decide to go ahead and lower rates by 50 basis points, play a little bit of catch up, and then we can talk about that. The other overlying trend I think we saw at the micro level, at the single stock level, is that companies who reported really good earnings, better than expected earnings, the share prices were rewarded, but not nearly as much as those companies who reported disappointing earnings. The stocks just got hammered. And that's referred to as idiosyncratic risk that's specific to a particular name. And it's sort of a problem for active managers, right? If you're picking stocks and every once in a while you get caught up in one of these, it's inevitable, but it's better if the penalty for being wrong is not quite as great, which is the case in a lot of instances. So that was very much typified. So I would sort of break the year up when you look at it in terms of sort of the statistics that Chris was talking about. Your big growth sectors were the big winners this year, right? It was technology, communication services, which is still basically technology, just of a different flavor, consumer discretionary, and financials. And within that, at the beginning of the year, particularly, ultra large cap, the Mag 7 carried the day, generated the majority of the returns. So in a nutshell, right, big was better, right? The S&P up about 25%, mid cap names up about 13%, and small cap names up about 10%. Then if you were a growth investor, you were way ahead of the game, right? Because growth, if overall market returns were 24%, but you slice it into growth versus value, the growth component was up 34% and the value component was up 13%. So large cap growth wins the day at the end of the year, and I'm thankful to say we're primarily large cap growth investors, and I would consider, based upon the responses I've seen from our clients and thinking about this in sort of institutional terms, our returns and how we've done this year have been generally favorable.
I want to say hello real quick, Chris. I'm going to come to you because I know you have something to add on to that. Just a guy, how you doing? Jim B. from Wisconsin, how are you? Scott Paul, JT, who's a client from Cyprus. Fast Eddie, how you doing, buddy? Fast Eddie's one of our, he comes to every single one of these live streams. We appreciate you. Drewski also saw you at the very beginning, so thank you very much for tuning in. Just a guy from El Campo, welcome to the show tonight. Chris, I know you have something to say, so what I wanted to ask you is everything Charles just went through is not that dissimilar from what we've seen over the past 10 years, where large cap outperforms mid and small cap, communication services and technology outperform all these other sectors within the marketplace. I mean, is this going to continue forever?
It's a great question. Yeah, the trend has been your friend. If you've been a large cap growth manager, you've been rewarded for 10 years plus. If you've been a small cap value manager, it's been a hurt locker. The other factor that's worked really well this year that I think Charles didn't mention is domestic over international. If you're a domestic manager, you've been ahead of the game. If you're investing overseas, you've had a drag on your performance. So is it going to continue into the future? Yeah, how much in debt do we have now? 64 trillion or whatever the number is, 34 trillion?
But excuse me, I hope it is. I believe it will, but maybe in a different fashion. I think we've seen now the market's given us a signal that breadth is starting to improve, right? It's not all about the Magnificent Seven, right? They were very important drivers to index level return. However, the law of large numbers caught up with them. You couldn't continue to generate accelerating revenue margins and return on invested capital. And so now that's begun to roll over. At the same time then, this other 493 stocks are exhibiting early characteristics of accelerating earnings growth, improving margins, and higher return on invested capital.
You know what? We've seen this a few times, right? We've seen, this is where you were going, we've seen the tech stocks lead, and then we've seen breadth expand over the market, and then that kind of stalls, and then it was FANG at first, 4 letters, then it was FANG with 5 letters. Now it's the Magnificent Seven, and there's been periods to where they've all led, of course, but then we start to see the other 495 stocks or so in the S&P 500 start to gain some traction. But still, the tech stocks continue to lead the way, the big names.
The big growth stocks, they're not necessarily all tech. I mean, is Netflix a tech stock or is it a communication or entertainment stock? So, and under Donald Trump 2.0, it's kind of hard to argue that there's not going to be more of the same, in that if you do lower taxes, who benefits the most? The companies are already making a lot of money, so it's a lot of large cap companies. If you lower regulations, it probably helps the large cap companies. Maybe it helps the small cap ones. That's the hope. But we own some small caps, we own some mid caps, but largely we're trying to buy fundamentals, and we're not really concerned so much as it's small, mid, or large. Is it getting better and sustainable on investment?
Sure. Who wouldn't want to own a company that's generating 25% top line growth, has just great margins, and just printing money because the return on invested capital is high. Well, that's a company like Alphabet, right? You know, and the whole group of Magnificent Seven. So there's certainly a place for those. It's just how do you adjust the weightings, right? Because the market's always sniffing out this changing dynamic of improving fundamentals, and so it's important to get ahead of that.
Yeah, so I want to, in a second, I want to ask you guys Brett's question here. Brett brings up something that's known as the Shiller PE, and what he says is the Shiller PE ratio is near all-time highs. How does that affect the stock bond allocation and withdrawal rates when putting together retirement plans? Ties into what you guys are talking about as far as where the economy is, the growth stocks that have been leading the way, the expansion and the widening breadth of the S&P 500, where other companies are really starting to have some acceleration in their rate of growth, and overall kind of where things are going. But before I get into that, I want to really tie this back into everything that Charles and Chris just said in a way that I think may make more sense for maybe the person listening who is not as sophisticated when it comes to stock market returns, as you pointed out, increasing sales, margin expansion, return on invested capital, which are some of the real drivers over time. Because we're going through this right now as a business where we have one particular marketing channel to where we spend dollars, and then what we're seeing is over time, the more dollars we spend, we get less and less of return on those dollars that we've spent. So as a business owner, we're clearly making a decision to allocate less capital towards that one marketing source. Does it mean we're going to stop allocating money to that? No. Does it mean we're going to look for other opportunities that may be out there? Yes. So we're seeing that. I bring this up because we're seeing that with NVIDIA. We're seeing that with some of these companies that have went from 500 billion to 1 trillion, 1 trillion to 2 trillion, right? There's only so many times you can double your value before you see a diminishing return on the invested capital. So that's what we're kind of going through, and I think hopefully that helps you understand a little bit. But that's as portfolio managers, those are some of the tough decisions that you guys are faced with because yes, these companies are kind of leading the way, but at the same time, they are seeing less and less returns on their invested capital marginally. Sales, they're still amazing, but they're not growing at the same rate. Profits are still through the roof, but they're just not quite as great.
Yeah, and that's the case at the company level, and then that's the case at the macro level too. If you start to look at things like where currencies are, where the dollar is, or where interest rates are, those things change these big companies' marginal return on invested capital. So, looking at the 2025, those are some things that we're looking at, keeping on the radar, whether it's, is the dollar going to continue to strengthen, or is it going to finally, peak? And it's been a headwind to earnings and revenue for a lot of these big multinational companies. Is it going to help start to be a tailwind next year? So we look at things on the margin. Are things getting better or worse? Are things accelerating, decelerating? And we're trying to be at the, right in front of the acceleration, and we're trying to get off the boat before it starts slowing too fast.
All right, great.
So to Brett's question here, or Brett, to your question, so the Shiller PE, it's cyclically adjusted, big word there, price to earnings ratio for the entire market. And what it does is it looks at where we are now based on compared to previous cycles. And it's a data point. So guys, when you're making decisions about which stocks are going to grow more in the future, possibly, there are a multitude of data points that are important, but this Shiller PE does tend to capture headlines, maybe not rightfully so, but when you're making decisions as portfolio managers, I wanted you to talk a minute just about the most important data points, the combination of data points, and really the storyline that they start to tell that can help you determine when we want to be less risk or more risk off versus more risk on, and how some of those things play into the decision-making process.
Well, you kind of ask almost two questions, really. Let's first look at it sort of at the single stock level, and then roll it up to the market level, right? So, whenever we are making decisions regarding the sizing of positions within a model portfolio or our mutual fund.
Do we have 1% for Starbucks, 2% for Google? Right. Position sizing, that's what you mean.
Yeah, right. It's predicated predicated upon the work that Chris and I do as fundamental analysts to say, well, how, what's my margin of error, right? How much cushion do I have in sort of my forecast? Is this really, we'd love to find really these really long-tailed secular growth stories, right? Because it just continues to go for a long period of time. And if we think that's the case, if the valuation looks attractive, we've got a margin of error built in, then there's a degree of confidence builds in this story and the thesis starts to pan out, then we will increase the position size. Or a lot of times it happens for us, right? The position will continue to go up in size as the opportunity becomes even bigger. And so it has a more meaningful impact on overall portfolio return. And so that's important to understand because that's very much different than what an index manager or a passive manager does. They just go based upon a fixed formula for each position and allocate it regardless of the investment merit. So we look at each position and measure, try and use a thoughtful approach to adjusting the position size based upon the risk return. Okay, you roll that up to the market and you say, well, a lot of people in this conversation, well, the market is expensive, right? The market is overvalued. And it's like, well, call it what you want. That's not a very good forecasting tool. That has nothing to do with an open-end, long-tailed secular growth story that has a margin of error. It's a point in time, like you said, it's a data point. So, the reason you highlighted, Troy, every reason why the market currently has a slightly higher than average valuation. Very strong sales, great margins, and huge returns on invested capital. That same attributes for all those stocks rolls up into the overall market. And the regular PE ratio on the market for forward earnings is about 21 or 22. That's 1 or 2 turns of the PE higher than the 10-year average. It's not in any way outside of unusual.
Nothing's going to crash imminently because of that one thing.
No.
And the last few times, if memory serves, Brett, that the Shiller PE was at historical highs, the market just kept barreling higher and higher.
Yeah, it's
I used to get so frustrated. I'd hear another fund manager at Invesco. Well, why don't you? It was always Walmart. Well, you'd ask, why don't you guys own Walmart? Oh, the stock's too expensive. Well, it's been expensive for the last 10 years, and it keeps going up, right? Why? I give you three guesses. Right?
Sales are increasing, margins are expanding.
Yeah.
so,
yeah.
and this is the Shiller PE. I mean, I've done this for 35 years. I've never had anyone come to me and say, I'm buying or selling because of the Shiller PE. I mean, it's talked about because he won a Nobel Peace Prize, or
economics.
For economics. As far as in researching it, what it says is your best percentage returns come when we have a recession. That's obviously when stocks look generally the most expensive because they're not earning very much. But you put your money in there and you'll compound the most over time. But the market has gotten much smarter at looking through earnings. If you had looked at earnings and only earnings, you would have said Amazon was too expensive to buy last year, 5 years ago, 10 years ago, 20 years ago.
Right.
Every year. You would never have bought Amazon, and it's now one of the top 10 largest market cap companies in the world because they took their cash and their marginal return on cash was 35, 45, 50%. And Jeff Bezos, in his infinite wisdom, was like, I'm going to just keep investing and not slow down because each dollar I spend can earn 40% or 50%. And so they just kept spending money, and everyone who didn't buy the stock, including myself early on, didn't look at the the cash flow that he was just reinvesting in the business. And that, as an investor, that's what you want, right? I'd rather not take my money out of a company that can compound it at 25, 30, 40% a year.
Right. That's our job, is giving money to those companies that can do that for us.
And Walmart's a great example. Starbucks, when they came public,
Yeah.
I think initially it might have traded at like 17 times earnings, which looked expensive. But if you looked at each Starbucks store at the time, it was earning 35% annual returns on cash.
Right.
So he just kept building new stores. And the stock traded at 30 to 35 times earnings, which always looked expensive, but the market was, like, hey, I'm going to pay up for it because it's going to compound.
Okay.
And that gets back to the efficient market thesis that everything's immediately it's all efficient. That's, it's way over talked about.
Well, it's antiquated in a way. What I was going to say earlier, because it brings up another point about modern portfolio theory, which has driven portfolio allocation at the institutional level for decades in this country. And what modern portfolio theory tells us, you've all heard it, a certain amount of large caps, a certain amount of internationals, some small caps, some bonds, some mid caps, spread it all around. Well, truth of the matter is, for the past 15 years almost, if you did that, you severely underperformed. You've probably lost out on hundreds of thousands, if not millions and millions of dollars. And while modern portfolio theory may be accurate with an infinite timeline, over short periods of time in the market, anything can happen. And this is getting back, I don't want to go down this path because just a guy asked us a really good question that actually ties in really well here. But it ties into the active management versus kind of passive management philosophy. Right. And you said it earlier, Chris, if you've been a small cap manager for the past 10 years or a value manager for the past 10 years, that's your job. That's what you do. You have to try to make, make burnt toast somehow still taste good because that's all you can do. You're in that box. And with index funds, and it's not that they're not bad, they've done tremendously well for people at a very low cost. But if you're an index fund manager, you get $100,000 in, you look at the S&P 500, you buy percentage-wise every single stock that's in that thing, the good ones and the bad ones. Now that interest rates are higher, we've kind of entered into this new normal. We believe, and I think many people agree, that we are entering a new era, potentially, for active management to significantly outperform this passive buy everything regardless of the fundamentals approach.
You made me think of one other thing, and I know we don't want to go down too many rabbit holes, but we see so many clients come in and their advisor will put them in 200 different stocks.
Their former advisor before they come over here.
They're very good. Yeah, thank you. Yeah, that's a very important point. Would have had them in 200 different stocks. They have to be diversified. It's like, you know what, right? That's a great story to tell somebody, but diversification statistically begins after you've owned the 10th stock. After you hit number 11, you're effectively diversified, right? Our approach is to say, you know what, here let's build these model portfolios in the fund with position sizes in them such that each individual position is large enough to add value if we're right, and if we should be wrong or that forecast suddenly changes, it doesn't impair the value of the entire portfolio. That's about 40 stocks. That's all you need to meet these efficient frontier and all of these theoretical and academic levels. Anything else is, in my mind, is just marketing and not adding value for a client.
Yeah, at the end of the day, your investment dollars want to go where it's treated best, right? And it's not that diversification is bad, but over the last 15 years plus, the whole notion of American exceptionalism is real because, regardless of who's been in power in DC, our companies in the United States have treated capital the best.
Right. Respectfully.
Respectfully, that's right. Even they're not all great, right? But China, it's a communist country. It did great for about 4 or 5 years when they were expanding into the Olympics, and once they launched the Olympics, ever since it's been a wreck if you're an investor, because they started regulating everything, and they said, no, we don't want to be capitalism. You go to South America, same kind of thing. The best performing market year to date is actually, it's not even the United States. I think it's Argentina because they because they decided to scrap their old. Yeah.
You also have to look at how bad they did last year.
That's also true. But everyone goes, well, why is it performing so well this year? And it's because they decided to move away from socialism and their other programs. So your money wants to go where it's treated best.
Okay, so I want to get to Just a Guy's question because it ties into a perfect segue to what we were getting into. Okay. Should the Fed continue cutting rates to limit the rise in the dollar? I'm going to leave it there because he then gives an opinion here, I believe it's an opinion, I think that is the reason given for Switzerland cutting rates. So I don't know if that applies necessarily to our conversation, but feel free to touch on that if you'd like, guys. But the dollar, Chris, should the Fed, well, first, why don't you define or explain to those who may not understand how the Fed raising rates or cutting rates impacts the value of the dollar?
I don't know. Currencies to me are very foreign. What I know as a portfolio manager.
Is that a joke? Currencies are foreign?
What I know, and it's on our list, I'm doing a video tomorrow, it's one of the top things on the list. The US market, the S&P 500 for 2025 wants a lower dollar, right? It'd be best, one of the best things that the market can have. How do you get it? Man, I don't know. The dollar went down in 2017 and the Fed was raising rates, right? Trump was talking about tariffs. We were going to fight with China. The dollar went down, earnings went up, the stock market went up. We want a weaker dollar. The dollar peaked back on Trump 1.0, literally the last day of the year in 2016, and went on a decline through 2017. As the Fed was talking hawkishly.
Well, I think you bring up a good point, because it is funny, because academically, you would expect as rates go down for the dollar to weaken. But in practice, sometimes you have these anomalies. Sometimes it doesn't quite work out that way.
You're exactly right. So the Fed has a dual, they always refer to it, a dual mandate, right? So the Fed's objective is not to control the dollar. The dollar is a byproduct of some of the actions that the Fed takes. But the Fed's mandate is for stable prices and full employment. And they use short-term interest rates, which they can control, to help foster that effect, okay? So that's what they can control, but there are a litany of other factors that may impact the dollar, such as trade balances, relative interest rates across countries affect how traders behave.
Short-term versus long-term rates?
Yeah, short-term versus long-term rates, right? Long-term rates are market-driven. So in theory, right, if we've seen peak interest rates, which there's a case to be made for that, as those interest rates come down, so will the value of the dollar, because you'll attract the U.S. will attract less foreign investment because it will be at a lower return.
Yeah, and so let me just kind of, we are getting into more complex economic discussions.
Yeah, sorry.
No, it's okay, but I like to take this opportunity just to explain what that means. So if you can get 5% in a money market account here in the United States, and someone, maybe in, a foreign country is getting 2%, well, they may sell their foreign currency and buy dollars to invest here in the United States. So that increases the demand for dollars, and just like any other asset or commodity, an increase in demand can drive the price up. So theoretically, or I should say maybe academically, when
that's the key, yeah.
When we have this increase in demand for our currency because interest rates are higher, it can drive the dollar higher. And when that happens, it costs other countries more to buy our goods, which, and oil's a big one, right?
Sure, right.
Because most countries outside of the BRIC nations have to convert their currencies into dollars to purchase oil,
and that causes less demand, and that weakens the economy, and then interest rates will tend to fall, and then the dollar will go down. So it becomes a self-correcting mechanism over time.
And on this subject, I just want to bring it to the here and now, because if you turn on the TV the last 2 days with what the Fed did yesterday, there's a lot of hysteria with regards to both interest rates and the dollar. And I warn people to calm down a bit right now, because the near exact same thing happened in December 2016, back when Trump was elected the first time. Janet Yellen on December 14th did her FOMC meeting, raised interest rates, talked very hawkishly about the next year, and interest rates went up, the dollar went up into the end of the year. It's very normal at the end of the year. People across the world hoard dollars. They want dollars on their balance sheet, and interest rates tend to rise into the end of the year as well, just because of bank lending and demand and stuff like that. So what's going on right now, the last couple days, very uncomfortable, given how quickly things moved in the last 36 hours and how much volatility spiked. but it's not unprecedented by any stretch of the imagination.
All right, so we're about to get into our raffle. So we are going to give away the first raffle for tonight in just a minute. Before I do that, we are going to, in the second half of tonight's show, we're going to discuss the Federal Reserve, the actions that they've recently taken as far as the speech that caused the market to drop 3% yesterday, the S&P 500, the NASDAQ to drop even further, and then, of course, the Dow. I think 10 consecutive days. I think I read today. It's obviously it's irrelevant, but it is significant in the sense that hasn't happened, I think, since 1950 or something along those lines.
Which the 70s or something, but yeah.
Which is 50 some years, believe it or not.
Yeah.
So we've had a lot of goings on over just the past 2 or 3 days we want to get into, and then of course Trump 2.0, because that's the second part of tonight's discussion. Where are we now? And we don't want to spoil too much for our upcoming live stream that we're doing for our clients. We're doing it, Heather, at Hotel Zaza? January 23rd. We're going to have a big live stream. We're going to have, I don't know, somewhere around 100 people, clients in the room. We're also going to broadcast it live, where we're going to give our 2025 stock market outlook. So mark that down on your calendar. If you're not a client, if you're not local, you want to tune in, because that's where we really get into a lot of detail about what we expect for 2025. But still, we want to give you some value tonight and talk about potential directions of where things could go from how we see them right now. But of course, in January, we'll have more information. So the Fed and Trump, what's transpired over the past couple of days, that's what the next 30 minutes is going to be about. Then, of course, we will have one more raffle winner at the end of tonight's live stream. So, Heather, go ahead and let me know who won, but I want you guys to put more questions down here, because we want to make this as interactive as possible. No such thing as a bad question. I promise I'll have these guys take it easy on you. But seriously, let's make this interactive, and I'd love to hear what you have to say. So, Heather, who's our winner?
Scott Paul.
Scott Paul? Scott, you are our winner tonight, so thank you very much for tuning in. Our marketing team will be in contact with you, and they will discuss what your favorite restaurant is, and hope you enjoy it. Dinner's on us. Okay. So Scott just comments. He says, is Santa going to rally, or is the Grinch going through? Oh, that's a good question. I like it. Play on words there. Okay, so we'll do this before we get into the Fed, because since Scott is our winner, he gets a little special preference here with the question. So, that happens to be a benefit of winning the raffle. Is Santa coming to the end of the year, or is Grinch gonna show up through January 20th?
So Jerome Ebenezer Powell showed up and spoiled the party. He was out there with his shotgun out in South Texas, like he was teal hunting, and took a shot at Rudolph and just about derailed him.
Yeah.
Yeah, I guess technically the Santa Claus rally isn't in front of Christmas. It's, I guess, technically the last 5 trading days of the year and the first 2 trading days of the next year. I don't see why it wouldn't come. I've done a YouTube video, I've looked at history. Santa Claus really starts at the end of October, right? The strongest period for equities historically is mid-October through the end of February, I think. Somewhere.
I was going to say January.
It's the fourth quarter through the first half of the first quarter. Yeah. So we're in the strongest period for equities. We had a big rally in November off the election. We've given a bunch of it up recently. The first half of December is usually down. We're down right now, I think, December to date. Option expirations tomorrow. And so a lot of the extreme moves that have happened this week, I think, are due to that.
Yeah. So. Just the guy says he hopes you don't say it's going to be sloppy and choppy in January.
Oh my,
that's funny. Charles.
Yeah, no, I was just going to say kind of what. Just really emphasizing. Now I'm thrown off. Well, what
he may have been talking about the weather here in Houston.
Yeah. So. Anyways. I forgot what I was going to say.
That's okay. Okay, so I want to get to the Fed because really what's happening here, and I find this fascinating, is it's this tug of war, right? It's the balancing of the Trump optimism versus the fear that the Federal Reserve is not going to be quite as dovish in 2025. So we see this kind of the scales kind of going back and forth and really whipsawing with such a tremendously volatile swing yesterday in the markets. And usually when that happens, we do tend to get a kind of a rebound the very next day, and that didn't occur. At least it did earlier in the day, but the markets closed basically flat. So I find it fascinating, this tug of war that's going on right now.
It is, because the shift in narrative has gone from, this slowing employment growth, and all focus was on the employment aspect of things, and now it's shifted yesterday to very much focused on inflation, okay? And so the thing that's keeping markets from rebounding more strongly today is the fact that tomorrow is the release of the Fed's favorite inflation gauge,
PCE.
the PCE, right? And so if that print comes in above hot, or inflation's higher, then I would say it's probable you'll at least get another knee-jerk reaction down in the markets tomorrow. But everything that's transpired here is that going into this meeting, everybody's expectations were for the Fed to lower rates by 25 basis points, which they did, right? And everybody expected them to based upon the expectations of Trump policy, or the GOP, sweep, that it would be stimulative and thus might cause the Fed to slow down the pace of interest rate cuts going forward. And everybody kind of knew that. However, what changed yesterday is in a couple of things. Within the expectations of all of voting Fed governors, they provide their forecast, which we all know is the dot plot. Anyways, those folks created a situation whereby their forecast for inflation uniformly went up above the Fed's targeted level. And the Fed did two things. Number one, they cut their expectations of the number of eases or lowering of rates they would have next year, and then created this situation where the question arises, well, how are you going to lower rates at all if inflation now is so imperative to reduce it, and everyone's expectations are for it to remain above the target level? So what did they do? They created uncertainty. What do you know about markets? They abhor uncertainty. And that's what really rattled markets yesterday.
They particularly dislike it when, and I don't understand why the Fed does this. The United States is when the Fed comes out with their decisions, we are the only market in the world that's tradable. Every other market in the world's closed. So if you're a European trader or an Asian trader, the only market you can trade is the United States, and you have about 2 hours to do it after it comes out.
Right.
So you have all these people, usually computers, trying to pile in to reverse positions in a very narrow window, and that's why, like yesterday, it starts to cascade because most people just see it and step out of the way and say, I'll just let these guys be done
quick,
with
and
it.
I got a question here from Joel who said something, and then we actually had a Bitcoin question pre-submitted,
yeah,
so we're going to have a crypto discussion in a couple of minutes
boy.
here, briefly. So we're going to go ahead, Charles. We're going to get to Joel, which ties into this, and then briefly touch on a crypto in a couple minutes.
So to Chris's points, right? The U.S. is the only market that's open, but equity markets, there's a certain amount of correlation. They behave in very similar fashion. So if you're a European portfolio manager and you stay awake late, see what the Fed does, and you see the reaction in the U.S. market, you generally know that your European equities are going to go down that day. So how do you hedge that? You'll sell all of your U.S.-based assets to try and minimize your risk. The second thing that's very, very important, Chris refers to them as computers, but they're really commodity trading advisors that trade leverage positions in futures, in currencies, fixed income, and in equities. And they trade in a trend-following manner and use various signals, one of which is spikes in volatility to adjust position sizes. And when markets start going down, their signals
pile
tell
in.
them
They all do the same thing.
they need to actually sell more.
They
have to sell more. Yeah. And so it creates this cascading effect.
Because the margin, because of
Their value
the
at risk
collateralization.
changes, and they just have to sell their collateral.
So there are a lot of things that go on behind the scenes in terms of trading and how things, how capital markets
Creates volatility.
behave. Creates a lot of volatility. Uncertainty created a lot of
Well, it
volatility.
particularly creates short-term volatility. If you look at vol structure yesterday, the front end of the vol curve went up in one of the biggest moves ever, but then you go out 1 month and it moved higher, but not anything like it did for the very short term. So yeah.
Okay, so again, we're we touched on this, and we cannot give personal investing advice here, Joel. We can only talk theoretically of what could potentially happen, but Joel brings up, if the PC is hot, is it a better buying opportunity? So, theoretically what you were saying is, and I want you to expound upon why it's likely the market may go down if the PCE comes in hot tomorrow. It may not. It could be the exact opposite. So again, this is not advice. We're not encouraging you to take any positions, because it could do the exact opposite.
So I'm a very probabilistic trader, right? I'm thinking, what are my possible outcomes, and
Degree of confidence.
the degree of confidence in what could happen and all. And if the market is so very much focused on that issue of inflation, and your next data point is an inflation data point, and it comes in bad, then market expectations would continue to shift towards the Fed may have to raise rates, right? It could get that extreme. And if that's the case, then the natural reaction is going to be for equity markets to go down.
And then when you couple that with the removal of friction from some of the economic policies of the incoming administration, deregulation, lower taxes, it could spur that fear of a growing economy,
Right.
inflation increasing, and the Fed becoming more hawkish in 2025. Because one thing that they said they weren't going to do was to become political, but we've kind of got some evidence maybe that's not so much the case.
Agreed. And so, and what we outline is a possible scenario that we think about and we prepare for in our hedge products and the way we think about things in our overall portfolio construction. But what I want to point out is that I don't think that anything that we've just talked about in terms of this uncertainty derail our longer term view that remains very positive.
Yep.
Okay.
Very good point.
What he said. I had something.
Sorry,
and,
we went too long.
Oh,
I need to
know
get
what
some
it- I know
younger
what it was.
investment guys on the
I
team,
know what it
apparently.
is. I've been this way all day. I left the enchiladas in the oven twice today. Inflation is
Which is the biggest possible mistake, because Chris makes the best enchiladas in
Yeah.
the entire world. There was an enchilada company that came around trying to recruit him away, and we had to increase his comp to keep him here, and it was a nightmare scenario for me.
Thanks, Troy. Inflation's seasonal. It goes up in the fourth quarter, generally in the beginning of the year, and it comes down. And the issue I'm having is the Fed thinks the economy is stronger than it is. The data that we're seeing in real time is missing numbers, right? Auto sales, home sales, all the bigger components of consumer spending are missing. The economic surprise index, which is basically how high above all these estimates the data is, has been trending down since before the election. So, I worry that, there's a runoff in all the gasoline that the Biden administration tried to throw on the economy in 2024. A lot of that stuff is trailing off and going to trail off in 2025.
No one's talking about that.
And no one is talking about it. And
Talking about the IRA Act, and then what was the other one?
the
CHIPS.
The CHIPS
The
Act.
CHIPS
which,
Act, and then there was one more.
Don't even remember.
I forget.
Yeah, I don't know. I just know it was a lot of money, and it did
Trillions of dollars.
And it did gas the economy, and there's still money in the pipeline to spend next year, but it's less. And if you're talking about cutting back on government spending, listen, I hate government waste, but it did provide a lot of the growth in 2024. So sometimes, what is it? Be careful what you wish for.
Yeah.
If we cut back on government spending, over the long term, it's great, but over the short term, it's not going to be good for the economy.
Well, that's a great point. So now let's get into some of the okay, great. President Trump's going to come in. They're most likely going to reduce regulations. They're going to reduce taxes, and they're going to reduce government spending. Theoretically, which I don't believe at the government. I don't believe the Republicans or the Democrats are going to reduce government spending. We'll see what happens. But theoretically, let's say they do. The downside to that in the short term is a problem. The stock market is not going to like that, because there's less capital out there to flow.
Yeah, there's less growth. Almost all the growth in the labor force this last year were government employees and healthcare workers, right? So, I don't like government waste, but at the same time, if you're having higher unemployment, regardless of where it comes from, that's bad for the economy,
Yeah.
right? Whether I'm paying for it as a taxpayer and I like it or not, more people on the unemployment rolls, bad. So,
And it's the simple fact of the matter, less money out there flowing, you have less capital, it's not going to be good for the markets in the short term. So you get into this, we don't really do politics around here, but we do money, right? Like what's good for your money. And lower taxes for corporations is better for your money. Less regulation for corporations is better for your money. But less government spending is also bad for your money because the stock market there will be some type of negative reaction in the stock market for that. So, okay, we have no more new questions that have been submitted, so we're gonna get to our crypto question for tonight. And I like this question first and foremost because he asked, why don't we have anything related to crypto in the investment portfolios? And I want you guys to talk a little bit about some of the Levi Strauss, right? How we can not directly invest maybe in a cryptocurrency, but benefit from some of its related. Let me ask the question here: some of the related entities that are involved in the industry. Okay, so Terry says, please talk about cryptocurrency and why you are not including any related investment in a portfolio. What would have to change for Oak Harvest to reverse direction on this situation?
I'm gonna let Charles cover most of this as far as what we have in the portfolio that's crypto related, but I'm gonna jump in first just because I think people forget NVIDIA was the crypto
you're right.
company for a couple of years. Their processors were used largely to mine all the cryptocurrencies for a number of years. And then people stopped mining the cryptocurrency and they had a huge pullback in the stock before they found artificial intelligence 2 years ago.
That's a great point.
So believe it or not, NVIDIA, used to be the crypto play as far as machining goes.
Yeah, so to Troy's reference, well, one thing I was just sitting here laughing. It's like having done this long, and we're actually, my wife would tell you I'm not a very creative person, but I tell you I can get pretty creative because I can figure out how to trade anything, and I mean anything. And so how do you trade, Bitcoin? Well, for us directly, Bitcoin's not a productive asset, right? So we talk to ourselves as growth investors focusing on earnings and cash flow, and obviously Bitcoin
And retirement investors.
And that particularly
retirement-focused
true.
investors.
Yeah, it generates no income. It's not a productive asset. However, that doesn't mean that we're not, aware of what's going on. We're old, but we're not that old, right? So. For us, we fall back on this the old Levi Strauss theory that Levi was a sharp guy because he saw all of the prospectors coming into California for the gold rush, and were risking life and limb to go out and prospect for gold. And he sat back and sold them picks and shovels and a little panning and the jeans, and made a fortune and slept well in his bed every night. We sort of take the same tack with this. What we do is look into help, invest in those companies that support trading activities in Bitcoin, right? So there's now Bitcoin futures, there's Bitcoin options, and so for us, the most immediate play are in some of the exchanges that support the trading activity in Bitcoin.
So when you talk about exchanges, so now that Bitcoin has become more mainstream, they have to clear through. Essentially, they're more mainstream. So you have
options and you have futures on Bitcoin.
But you
so
can invest in those option platforms. You can invest in
right.
those.
The investors utilize these platforms, the Chicago Board Options Exchange and the Chicago Mercantile Exchange, as venues to trade in Bitcoin. So to the extent that these activities and trading activity increase and it gets a broader appeal.
As trading activity
increases, creates more volume for those guys.
Bitcoin-related direct investments that are now publicly available,
right.
the revenues directly increase to some of these side entities,
right.
which are far less volatile compared to Bitcoin, because our very first rule is focus on protecting your money, right? We are a retirement-focused firm. Our clients, they've accumulated their wealth. It's not about trying to double it overnight. If I could wave a magic wand and double your money, it probably doesn't change your world. But if that same magic wand waves and you lose half, that could have an impact. So our first and foremost responsibility is to be a steward to your money. So without getting into the merits of cryptocurrency in and of itself, I think we can all agree that it has tremendous volatility. And Charles, nor Chris, nor myself can accurately assess when that volatility is going to occur to the downside. And when that happens, you could quite easily see 50, 60, 70, even 100% of your entire investment evaporate. And for us, that's just far too aggressive for the people that we have been employed to care for. Now, it does not mean that we cannot identify the trend in the marketplace and say, okay, where are the Levi Strausses that are out there that are maybe selling some picks and shovels to these prospectors? And that's the position that we take, and we think it's the correct position.
Yeah, I think for the first 10 years or so of Bitcoin, its average pullback was 85%. Right, so if you had $1,000, you know, it was $150 on a pullback.
Yeah.
With it becoming more institutionalized, ETFs, BlackRock, and et cetera, I think some of the volatility is going out of it, which also means some of the upside is probably going out of it over time as well. But it's just not something we hold currently as an asset.
Geo Pepsi, I figured you'd show up here tonight. Thank you very much for attending. I guess we have a question that we sent out here. Okay, so guys, we're going to have the next raffle in about 10 minutes here. But I want to go ahead and transition over to opportunities and ways to mitigate risk in a falling market, or how do we can't get into some of the specifics here because we can't give away some of the
secret sauce,
so to speak. But what we can talk about, because we had a great question from Alan here. Alan says, as the market keeps hitting all-time highs, what signs do you guys look for that may indicate the market is due for a correction? Chris, this is right up your alley. And when do you identify a projected, or when you do identify a projected downturn, what steps are taken, if any, parenthetically, to limit losses in a portfolio heavily weighted in dividend stocks? And I can talk a little bit about the purpose of dividend stocks. But Chris, let's do this. Chris, you talk a little bit about maybe some things that you've seen in the market when you're looking at volatility, forward vol, things that may say, hey, you know what, there could be a hurricane coming. You know, what are some of those things that you look at that help you identify when potentially a storm may be coming?
Well, stocks go through cycles like our economy goes through cycles, and there are different stages to economic cycles. There are different stages throughout the year that investors behave very similarly. And so I studied a lot of stuff about that. When it comes to volatility, I mean, you know, there's volatility that you are seeing on your screen, which is realized volatility, and then there's implied volatility, which is kind of the insurance out in the future. You know, and honestly, you know, Charles is as good as anyone is as far as looking out at forward volatility and seeing kind of where there are holes in the market. We have a product that we've talked about that has the tools and the availability to basically hedge some of the downside risk. And you know, Charles spotted kind of a hole in the volatility markets earlier this week and was able to kind of help hedge this tool short term, and it worked out great yesterday. You know, on that big down day.
I think things that you look for are, you can see if fundamental things like, you know, if we do believe that interest rates are going to rise for the wrong reasons, you know, inflation is apparent and the interest rates are going to rise, you know, it's going to lower valuations, the discount rate for valuations, or it's going to lower valuations because of the discount rate change. It's going to increase funding costs, making it more, you know, impair return on invested capital. We look for when credit spreads, right? What are investors willing to pay for various credits? You know, right now,
high quality versus poor
quality versus low quality.
Bonds.
And when that starts to widen out a bunch, that's a great sign that risk is coming. We'll look at Bitcoin, and if Bitcoin goes meteoric for some reason, and there's, you know, just so much, you know, irrational exuberance in the market, what we have done, and we did it at our predecessor firm, was create a product which basically says this, right? As fund managers, we think we have an edge in picking stocks. That's where we can add value. There's this whole other element, though, that's the overall market risk, the systematic market risk, that you don't necessarily have the same edge in, and that presents a very large risk, potentially, to overall portfolios, because it's your overall exposure to the market. So we spend a tremendous amount of time, and we have a very talented colleague that works with us that helps us build the models, Dwayne Botchak, who's our director of research, that we built tools that allow us to use this equity or this equity index options and the construction of a basket of those to create a hedging effect within the portfolios, within the mutual fund portfolio that we run. And you're only able to do that within the context of this mutual fund or a hedge fund. It's not, you cannot do that in a single stock or a separate managed account.
So it's a complex answer to what seems on the surface as a simple question, but the truth is, first you have to be able to identify using forward-looking data, right? We don't want to look at, when they talk about on CNBC about the jobs report. The jobs report is past data, right? Like the market knew way ahead of time that the federal government was probably lying about the number of jobs that were created. Like that data is 2-3 months old. That's old news. It's about identifying which forward-looking data points out there, what they're saying, and then having the expertise and the experience to find different holes in the market, and then putting that story together.
You have to,
and then making a decision, then actually having the to make the decision.
Yeah, you have to have a very good set of tools that allows you to measure, monitor, and manage this risk.
Yeah.
And you have to have the tools that allow you to model it up such that you can have, in a very capital efficient means, a third leg to your stool here that always has in place this strategy of downside protection that doesn't cost you a fortune to operate.
Yeah, because the biggest cost that someone could have is they get it wrong, right?
Agreed.
That's
Yep.
the biggest cost.
Yeah.
You lose 40-50% of
Right.
your investment.
Yep.
So look, and I want to talk a little bit about dividend stocks here because Alan, it's a great question, and I know that was like, graduate level 4,000, answer, but it's not a simple answer to it. But we tried to, without giving too much information away on a publicly available broadcast, talk about some of the de-risking strategies that we do utilize in-house for client portfolios, some of the hedging mechanisms that we do have available for other strategies than our dividend portfolio. Because the truth is here, if you're in the dividend portfolio, and I've said this for 10 years, you want the market to go down. Now, that's academically, right? Because when the market goes down, your dividends, when they pay out, you are buying shares at much, much lower prices. And those shares that you purchase when the market is down will be probably the best performing investment in your entire portfolio. But theoretically here, or again, academically, the longer the market is down, the more you reinvest and buy at lower prices. We only ask you to believe the capital markets work over time. And so when they rebound, if they do, like they always have, then those shares that you've reinvested and purchased, they're going to do a few things. One, they're going to be the highest returning assets probably in your portfolio because you bought them at really, really low prices. But you bought them, think about dividend yield. If something was trading at 100, now it's trading at 30, and you buy a bunch of it here, and it was paying a 3% dividend here, okay, now that dividend may be a 10% dividend, right? Because the price has been cut so much, but the dividend, again, theoretically has not changed. So those dollars are not only expected to appreciate the capital tremendously, but the dividend on those dollars is. So you should be in the dividend portfolio because one, you want income, two, you want less volatility. But in those recessions, they're actually a tremendous opportunity to allow dividend stocks to do what they do best. But if you are interested in protecting against short-term gyrations in the market, you should definitely talk to your advisor about the hedging strategy that we have, which unfortunately in the dividend portfolio we're not able to apply. Your advisor can talk to you more about that, but it is available if you want to explore that further.
Quickly on dividends, just think back to 2022 when the market went down. we had a recession. You know, the GDP shrank, earnings. Oh, I think GDP shrank. Yeah, earnings shrank. The S&P went down. I think it was 25% in nominal terms and 35% when you add inflation, something like that. No, 35% in nominal terms, 25% in real terms. Dividend stocks, I think, were down 8 to 10%, and growth stocks, you know, the Nvidias, the Facebooks and stuff, were down anywhere between 35 and 60%, right? So the dividend stocks had that cushion. So, you know, I don't think you
They're
would
less
want
volatile, historically speaking.
less volatile, both to the upside and the downside, right? You're giving up some of the upside because you want that income down the road.
Yep.
So yeah.
Okay, so I'm going to answer this question, I think. You guys correct me if you think I'm incorrect. I want to keep it simple. We have the raffle winner we're about to announce, and then we're going to kind of go for a free-for-all. So Straight Jacket and Scott Paul also asked the same questions. I love Straight Jacket Studios. It's like you own a mental hospital or institution, a studio with Straight Jackets. Both of them surround oil and gas stocks and their prices under a Trump presidency. And the simple answer is, when production is increased, oil and gas companies typically perform less, right? Because prices of oil goes down. Price of oil goes down. I saw this happen to a lot of clients, prospects I talked to back in 2015, 2016, prior to Trump's first election. They're like, Trump's going to increase production. It's going to be amazing. Why don't we own more oil and gas? Well, the truth of the matter is, Democrats are like the best thing for oil and gas companies because they cut off all the production, they stop the leasing on the federal lands, and we see the price of oil typically skyrocket. Happened under President Obama, happened under President Biden. When you increase production, simple supply and demand, the prices drop. Scott here points out that they seem to be on a free fall lately, oil and gas stocks. So anything you guys want to add to that?
That's spot on exactly what you said. That coupled with, remember, a lot of global demand incrementally comes from China when it comes to commodities, and China's a mess, right? One of the best things that could probably happen for our stock market and global stock markets is China to actually stimulate their economy in 2025, you know, to combat Trump or to do whatever. But their economy is a mess. It's actually dragging down our economy. It's one of the bigger risks for 2025, not that they go to war and stuff, but that their economy continues to just flounder. And they're actually exporting deflation to the rest of the world. I mean, our auto companies, Ford, GM, all of them are having a big trouble because they're competing globally against the likes of the Chinese auto manufacturers, and they can't do it right now.
We're going to do the raffle winner right now, but Joel, Chris, you're going to love this one, has a question about buying inverse funds. Ties into the dividend fund strategy. We're going to read that question in just a minute. Heather, who is our second raffle winner?
David Friedel.
Friedel? David Friedel. Hopefully I'm pronouncing that correctly, but David, congratulations on being tonight's second winner. If this conversation stays lively and we have a pretty level number of people still tuned in, we may do another one in 15 minutes or so. We'll see how that goes, but David, you are the winner of our second raffle. Our marketing department will be in contact with you to learn what your favorite restaurant is and coordinate the delivery of that for you. So thank you very much for tuning in tonight. Okay, so I set this up because Joel asked the question first. Let me read it. With the dividend strategy, if that's a type of dollar cost averaging as the market goes lower, is there a school of thought that says, hey, maybe I should consider buying an inverse fund here the same way as the market goes higher? Don't quite understand the second part of that question or how it ties together, but I think I get it. Inverse funds, right? Let's just, in general, because this will answer your question, Joel.
Because you know my answer?
Yeah, because look, if you're in the trading game, not the investing game, and you're going to hold something for one day, an inverse fund is something you could potentially consider. It could also blow up and you could lose a tremendous amount of money. But as far as an investment and considering holding them long term,
I would never ever buy one. Mathematically, they make no sense. If you're scared that something's going to go down, sell it or buy a put. But I would, unless you're going to sit there all day and it's enough money that'll make a difference in your life and trade it, I would never do it. The guys who make those products have math backgrounds, far better than anyone in this office and probably on this
Planet.
Yeah, and it's they're made to sell. They're not made to invest in. So I just
Yeah, Wall Street is wonderful at creating products that people, if there's any sort of perceived need for something, they'll build it and sell it because.
And then layering in the fees, right, that they can extract through option.
Oh yeah, it's there's nothing benevolent about capital markets and Wall Street. It's all done as a profit-making motive, and that's what is behind these folks that sell products like this. It has gotten so extreme that the nature and some of the products that have come out have caused the SEC to put in place regulations that actually causes folks like us to have to really go through unnecessary reporting requirements for the legitimate hedging strategies that we run.
Yep.
Okay, so it's that most of that stuff is rat poison.
And Joel, I'll tell you this: if you can actually read the prospectus of that inverse fund, any one that you're considering, just in general, and understand what it says, I'll give you a job.
Yeah.
Well, he says he tries to clear it up here, dollar cost average into an inverse fund, since it will go lower as the market goes higher. That's the thing; it won't necessarily.
No, it won't.
These things can blow up and do exactly the opposite. Yeah. So we actually read the prospectus. It's.
I learned my lesson. I mean, I was right directionally trying to trade those 3 times and lost money 3 times, and I couldn't figure out how. And then I went and I read the prospectus, and I was like, oh yeah, okay.
Math.
I'm not supposed to make, You're
well,
supposed to be
but you have the background to actually
perfect.
do the math and to actually
You have to be perfect.
look at it and calculate it.
It's just not worth it.
Okay, so guys, what do you have here? Questions are drying up here. I think we could get into Gary's question, which is more political than anything. We could keep it non-political to an extent, but okay, here we go. Gio has a question. You think any big plays showing with, for example, big pharma, with too much confidence? Gio, I don't understand. Could you retype that, please? Don't quite get that. Okay, Cindy says, any news on the Trump tax cuts, the Tax Cuts and Jobs Act staying in place for those of us doing Roth conversions? Just getting to the program. It has not, Cindy, this has been all investment related, but the program didn't start until you actually got here, so thank you for showing up. No, we've been having a great time. It's been mostly about investments, but Cindy, no. There isn't any news except that the incoming administration has said tax reform will be a priority, and it's something that we expect to get done, whether it's an extension of the tax cuts or most likely a new piece of legislation that maintains some of the elements of the Tax Cuts and Jobs Act and then add some more in there. I think that's the most likely outcome. But no, we have no clear news of anything taking place with that. Okay, makes more sense here, Gio. Thank you for clarifying. RFK has been nominated as the Health and Human Services Secretary, and we've seen some of those companies suffer a little bit stock price wise. Without any legislation being happened yet, Gio, I don't see a question here, but I think what you're saying is there anything to be concerned about? Anything discussion point wise here?
We weren't quite sure kind of what to make of that in any real clear manner. So where we were clear is that with the incoming administration, there would probably be pressure in reducing, Medicare and Medicaid, and that is a very large payer to a number of service providers, like primarily hospitals. So one of the things that we did sort of day 1 or day 2, no more hospitals, right, in any of our model portfolios. We've got fairly limited exposure to large cap pharma. Some of them in our dividend model, we're very comfortable with what we own. Most of what we own is in med tech. and those are pretty much outside the realm of
Medicare's
anything
not
that's
paying
being,
for knee replacements, right?
Well, you know, there is some coding and all for that, but the secular drivers for hip and knee replacements is very, very strong. The manufacturers of those products are in very good position to maintain their margins, and so it's not as direct. It's tangentially, you bet, but anything that involves like capital expenditures by healthcare providers such as hospitals may be at risk. And so we make sure that we make the adjustments such that we're not exposed to some of those.
So that's interesting. Is that kind of like what things that are maybe is it some of the fraud and stuff? Because like certain things are government mandated when it comes to Medicare, right? Like they
Right.
can't be cut back, you know, by any means. But the fraud can be cut back, and some of the
Sure.
abuses can be cut back, and some things that are maybe on the fringes. What particular, if you don't mind, kind of going a little bit deeper?
So
there.
if hospitals, if pressure is being placed upon Medicare and Medicaid as to who is eligible, what benefits you might get paid for, and go back to hospitals again, you may see lower reimbursement rates for your patients in terms of what the government pays. And then in addition to that, the next stage of that is then that's going to impair the budgets of hospitals who are large purchasers of capital equipment, things such as hospital beds. So there are companies out there that, very good companies, they make a lot of equipment that's sold into hospitals. Incrementally, those products or those expenditures will be cut back and those companies become at risk. So you sort of have to look at you look at everything in terms of the food chain and see where the biggest risk is, and we try and make sure that we're
That's an
insulated.
interesting point, because that's the true driver of sales, margins, and return on invested capital, and identifying people within the food chain. So you have this big legislative potential impact or policy decision.
Right.
Okay, what industry does it impact? Which companies does it impact?
Right.
Which companies do they do business with that may be most impacted?
Sure.
Really kind of following that domino effect throughout the food chain to, and then it's the fundamental analysis. It's
Right.
where are these companies already? Is this going to positively or negatively impact their sales margins and return on invested capital?
Right. And so, to stay within the healthcare theme, companies that provide, things like robotic surgery, right? Very efficient use of the hospital's time, profits, and such. So they would continue to invest in equipment such as that, whereas number of beds needed, maybe not so much.
Yeah.
And we took some swings at some drug companies earlier in the year, and
Got to be careful. You can't say that these days, right? Not literal swings. make some
swings and
investments.
misses, and got rid of them out of the portfolio. But like a lot of the drug companies, it's RFK and the new administration, drug costs here relative to overseas, what they charge overseas, the discrepancy is
It is
massive.
There
right?
needs to be a massive overhaul to everything, right?
The healthcare group, just in the last 2 months, I think is one of the worst performing groups, except for a lot of the medical tech device companies that Charles was speaking of.
So I think the bigger thing here, and it's a really good point you bring up, Gio, it's the uncertainty, right? So when you have an unknown like RFK put in charge of a huge government agency that has a massive outreach, what does it do? It creates uncertainty. What have we talked about for years on these live streams and in events? The market doesn't like uncertainty. The market is a mechanism that likes to be able to value a company's future cash flows that are coming in. And the moment, I mean the moment, any uncertainty is introduced into that math formula, that calculation, guess what happens?
Sell first and ask questions later, because anything that he does is going to be negative for the profitability and the shareholder of those companies.
So you want to get out before, you want to be the first one in the movie theater, right? When someone screams fire, you don't want to be the person in the back of the room. You want to be near the door, you want to be the first one out, and that's how it goes.
And maybe it all settles out next year and it's not as bad as people expect, and we'll be looking for opportunities there in companies that are growing organically.
So for us, we have absolutely zero emotional attachment to any of these names, and it's just predicated upon that risk return that we talked about before in terms of, what is your margin of error? How do you size these positions? And as that risk level increases, the position size goes to zero.
Well, let's get back to passive investing versus active investing, because if you own an S&P 500 fund, and now RFK is the Director of Health and Human Services here is introduced, if you're a passive fund manager and you own SPY, for example, an index fund or an ETF that just tracks the S&P 500, you're making absolutely no changes. When a dollar comes in, you're investing proportionally in that company, just the same as when times were good, as if now times are uncertain.
Yeah.
The market doesn't act like that. It doesn't behave like that. And we are entering, now that interest rates are higher and the cost of capital is a bit more, kind of a new period here where this is a great argument to where, as an active manager, you can say, you know what, there's some uncertainty here. I have the opportunity to get ahead of this curve. I'm not just going to blindlessly throw 2% of my money into United Health. And I believe it's probably a larger portion of that of some of the indexes. But
Sure.
Which actually kind of gets to one of your points earlier in the live stream, was the Dow being down 10 days in a row. I don't look at the Dow. Charles doesn't look at the Dow. It's a price-weighted index. It's been down 10 days in a row because UNH was the largest weighting in the Dow because it had the highest dollar. I think it was a $500 stock.
Yeah.
And the next highest one was
I don't have any idea.
Goldman Sachs, because
Yeah,
it's a
sounds right.
high stock. And then, Apple's only 100 and, what is Apple? 240. So that was like half the weighting, even though it's I don't look at the Dow.
And no one really in the industry does.
There's some ETFs that trade
ETFs,
it.
index
Yeah.
managers, passive managers that track the Dow for sure, Dow related. But for the most part, like when industry people talk about the market, they're not talking about the Dow. Like, to me, it's always been confounding why you turn on the news.
It's just
and
because
the Dow was down, this or that.
It's
And you know why?
been
the
there
percentages,
forever.
It's the numbers.
Yeah, it's been there
It's been there
forever,
forever.
right?
Yeah.
So.
Okay, Steve, we can't give. He asked, what do I think of VMFXX instead of BND? So we can't get into individual security advice here. We are licensed. We're investment advisors. Don't know your situation. There are pros and cons to every investment, so we can't speak on that without understanding your particular situation. Okay, I tell you what, Heather, 5 more minutes, guys. We're going to get a couple more questions here. If we can get a couple more questions, we'll do one more raffle, and then we're going to call it a night. Paul, great to hear from Paul. So we've had Gio tonight. We've had Drewski. We've had...
Want to answer that one?
I haven't read it yet, but you have. Go ahead.
So Paul asks our thoughts on the ballooning national debt. So I will say this, as I've said it for 20 years. It doesn't matter whether you're Republican or Democrat. Politicians have spent equally absurd amounts of money. Tax cuts, when we're running deficits, are debt, right? So when Trump, I love the Trump tax cuts, right? It increased our debt as a nation. It's just the math, right? We're not funding these things. Is there a tipping point? Someday, I guess. If you can find it, call me. I'll hire you. I've listened to, 100, multi-billionaire hedge fund guys talk about it for 15 years. They've all been wrong. They don't care because they're all retired. I don't know. I don't know what the tipping point is. The dollar is still the currency of choice globally. As much as anyone talks about going off the dollar, which people are, that's why crypto's been so good. That's why gold's working. But it's all relative.
I'll tell you this, Paul. The truth of the matter is, there is no revenue answer to this problem. It's a spending problem. So if we really want to be focused on the national debt, we need to kind of change that conversation and focus on spending. And yes, you could say tax cuts is spending because you're creating a policy that will bring less revenue in. But no, we spend too much money, on frivolous, stuff that just simply doesn't matter, and we shouldn't. And you can't spend. Let me tell you this, Paul. So more than 99%, last I checked, let's call it almost 100% of all the tax revenue that comes into this country goes to cover Medicare, Medicaid, interest on the debt, Social Security, and the Affordable Care Act. Okay, that's 100% of the tax revenue. So every single thing else, Department of Homeland Security, the FBI, the CIA, Department of Education, Department of Labor, the FBI, you name it, all of that money is borrowed. All those salaries, all those government buildings, all those plane trips, and all those vacations, and all those everything, it's all borrowed money. So in no world is it possible to increase taxes to get ourselves out of the situation. When you look at where we are, it is a spending problem. And the problem is you have a bunch of people in Washington D.C. spending money that's not theirs. You know, I'm not going to attempt to try to recreate what Milton Friedman said, but if you Google it on YouTube, he had something that was amazing. It really stuck with me over the years, where he's talking about spending other people's money, and essentially the most inefficient means to spend capital is to spend other people's money because you don't care about the quality of what other people receive, and you don't care about the quantity, what it costs. So if I spend my money on Chris, I'm gonna maybe not so much care about the quality of what Chris receives, but I'm gonna care about how much it costs me. If I spend Chris's money on Charles, well, guess what? I don't care how much it costs Chris, and I don't really care what the quality is that Charles receives. But if I spend my own money on me, I'm going to really care what it costs, and I'm also going to care about the quality that I receive. Now, that's theoretical. Of course, I love these guys, and I would care about them. But if replace the government with me in that metaphor, and you very clearly understand that if I'm receiving money from Chris only to spend money on Charles, look, I don't care what it costs. I don't really care about what Charles is doing. I have my own life to worry about, my own things going on. And that's the true problem in this country is we have a bunch of people who are elected in a lot of ways, oftentimes not elected, making decisions about what to do with other people's money on other people, and they just don't care. You know, there's no efficiency there. That's the problem, Paul.
If I would have heard that earlier, I would have had you as my write-in candidate for president.
Yeah, well, Milton Friedman, he was, you know, he had a way to articulate things that not everyone else necessarily can.
And the good news, if there is good news, it's not just the U.S.
No, it's every other country in the
Every
world.
country, except for maybe Switzerland and a couple others, is in the same situation. China is in this situation. Every third world country in South America is in this situation. Every European country is in this situation, except for I think Switzerland. It's global. I don't know why, but generationally, it's been going on for 40 plus years, increasing deficits and increasing government debt.
I have the best news of the night. Ed Rossi is bringing dino ribs in tomorrow.
Yes.
Okay, so dino ribs, they're the big beef short ribs. Many of you probably know, but Ed Rossi, he's an advisor here. Ed, how you doing? He makes some of the best dino ribs out there. So what are you, Ed, are you just tuning in now? Or are you just getting done with an appointment? Don't you have some other work you should be doing? Just teasing you. But so I have a new baby and also a new home that I moved into that wasn't quite done. Renovations were being completed, so I've been working from home for the past couple of months. But Ed, you are seriously making me consider coming in tomorrow for those ribs. So they are amazing. Okay, I promised if you guys stick with us, we're going to do one more raffle. So we're going to do one more raffle. If you have a question, now is the time to get it in. Otherwise, we're going to clock out and go home for the night, spend time with our families. So while we are getting the raffle winner for tonight, feel free to put your question in. Otherwise, we'll see you, I guess, January. Heather, when's our next one? Late January?
No, it's the Market Outlook.
Oh, it's the Market Outlook Summit. That's January 23rd. Okay, so late January. But that's, okay, so January 23rd. If you're a client, please show up. If you're not in Houston, feel free to fly in. This is our big event for the year. Typically, we have about 100 people there. Very, very nice event. It's at Hotel Zaza right here in Memorial City in Houston, Texas. And it is it's a great time. And we are going to live stream it. But guys, anything you want to mention about the upcoming event?
Oh, about the event? Yeah, no, it is. I think it's a great event, and it allows us to communicate again. One of the things that we like to do is, say what we do and then do what we say. And if we can communicate that to a large group of our clients, then have a much better understanding of what it is that we do, and they understand some of the day-to-day things and returns and what they see in their accounts. And I think it's a very worthwhile event.
Concur. I was speaking for you.
Yep.
All right, Heather, who's the winner for our last raffle for tonight?
Jim Harper.
Harper?
Harper.
Jim Harper, you are the winner of our last raffle for tonight. So Jim, our marketing team will be in contact with you. Everyone, we really appreciate you tuning in. This has been an amazing night. I hope it was very valuable and impactful for you and your retirement. If you're a client, we thank you tremendously. If you're not a client, reach out to us if you have some questions. Otherwise, we will see you next live stream, which will be our client event, January, here in Houston, Texas, where we stream it out live to everyone, but we have a bunch of people in the room. So we look forward to seeing you then.
Have a